Okay, let's talk about General Mills. Their latest earnings report, well, it was a textbook example of what we call a messy beat. So what does that mean? It means on the surface the numbers look pretty good, but when you dig in, the real story is all in the details. We're going to explore how they managed to impress investors despite facing some pretty significant challenges. Let's break it down.
All right, so here's our game plan for today. We'll start with that surprising beat and the numbers that really move the market. Then we're going to get into their Remarkability Playbook. After that, we'll look at a tale of two very different segments of their business, check out their guidance and the headwinds they're up against, and finally, I'll give you our take for the next call. First up, let's look at the numbers that surprised Wall Street and really set the tone for the day.
So on the bottom line, General Mills posted adjusted earnings per share of $1.10. Now, that was a solid 7-cent beat over what analysts were expecting. A nice start. And it wasn't just earnings. You look at the top line, revenue came in at $4.86 billion, which cleared expectations by a comfortable $81 million. So there you have it, a beat on both the top and the bottom line.
And here's how the market reacted, which tells you everything you need to know. The stock jumped almost 3.5%. And get this, it was on nearly 3 times the average daily volume. So it's pretty clear investors liked what they saw.
So here's the big question. How does a company with some pretty significant weaknesses manage to impress the market so much? Well, the answer seems to lie in their strategy, which they call the Remarkability Playbook.
And this right here is the core of that messy beat. I mean, on the one hand, you've got some pretty ugly year-over-year numbers. Earnings down 21%, revenue down 7%, margins getting squeezed, not great. But on the other hand, they beat expectations, and this is the really crucial part. They stood by their full-year forecast. And that's what gave investors the confidence to start buying.
Management's whole story was centered on this Remarkability Playbook. You know, in an environment where consumers are super price sensitive, focusing on managing price cliffs, those big price gaps between their brands and the store brands, is a really savvy move. It's all about proving they can stabilize sales without completely destroying their profitability.
And the CEO, Jeff Harmoning, he backed it all up with data. He came out and said that over 90% of their pricing adjustments were meeting or even exceeding what they had expected. I mean, that's a direct signal to the market that their plan to stabilize the business isn't just a theory, it's actually working. Okay, so let's move on to the segment Performance, because this strategy, well, it isn't playing out the same way everywhere. It really is a mixed picture. As you can see right here, there's a huge difference in how things are going. The North America retail segment, which is their bread and butter, was down a whopping 13%. But the pet segment, on the other hand, was up 11%. It's pretty clear that pet is still the company's main growth engine. And a key reason for that pet segment growth is the launch of Love Made Fresh, their new fresh pet food brand. With almost 5,000 of these coolers already in stores, the brand is off to a really strong start, grabbing about 5% of the market in its initial rollout. This is definitely a product line to keep a close eye on.
Okay, so you've got a challenging retail picture but a booming pet business. What does management see for the rest of the year?
Now this right here was maybe the most important signal of the entire call. Management reaffirmed their full-year guidance. In a volatile market like this one, when a company stands by its numbers, that is a powerful sign of confidence. It tells investors that despite all the current choppiness, they believe their plan is on track.
But, and this is a big but, they were very transparent that the road ahead is going to be bumpy. They got a boost from some favorable shipment timing in Q2, but they expect that to completely reverse in Q3, which will create a significant drag on profits. The real recovery is slated for Q4, so investors are definitely going to need to be patient.
So what could throw a wrench in this carefully managed timeline? Management pointed to 3 key external risks. You've got persistent inflation, the potential for tariffs to add another 1 to 2% to their costs, and the continued financial strain on lower and middle-income consumers. These are the big wildcards they're watching closely. So you have reaffirmed guidance, but a bumpy road ahead and some clear external risks. What does this all mean for the stock? Let's put it all together in our final analyst take.
Okay, here's the core thesis. This messy beat signals that the worst of the volume declines might be over, but this is not a sharp V-shaped recovery. The Remarkability plan is showing early signs of working, but profitability is the next big hurdle, especially with that guided weakness in Q3 before a Q4 rebound.
And through it all, the pet segment remains the undisputed crown jewel and long-term growth engine.
So what's our call for next quarter? Well, we think there's a good chance of an earnings miss, and that's mainly because the company has pretty much already told us to expect a tough Q3. We're predicting a bumpy ride for the stock as investors digest that news, and that's why we're giving General Mills a market perform rating.
Now, for an outrageous but plausible trade idea, given that General Mills seems to be a first mover in aggressively managing its price gaps to get volume back, you could consider a pairs trade. You'd go long General Mills while at the same time shorting a competitor that's been slower to react and is still struggling with its own volume recovery.
And as always, this is not financial advice.